Hey, how's it going, everybody? Today I want to talk with you a little bit about this recent report that came out from Zillow just a couple days ago, where they forecasted that home prices in the United States were going to fall in 2025. So this is kind of a big thing because most of the news and media attention I see on the housing market is generally bullish. It's generally very positive. And so a lot of these big real estate related companies are very hesitant to put out any sort of negative news indicating that prices might fall. So they just came out recently and they're saying that prices are going to fall. So I want to share with you guys a little bit about that news, as well as what some of the other leading indicators are showing us, and then really just talk a little bit more in depth about why that's happening and what conditions are going to need to exist for that to continue to be the case, or what might need to happen to actually change things and cause things to go back in a positive direction. So let's go ahead and jump right in. So first off, here's the article that just came out the 18th of April. And here's what they're saying. They're saying, latest forecast indicates a decline in home values coupled with an increase in existing home sales for 2025. While mortgage rates are in an especially unpredictable period, barring unforeseen shocks, Zillow expects rates to end the year near 6.5%. Home values are projected to drop 1.9% this year, a revision from previous expectation of 0.6 increase. So they're saying that they're expecting prices to drop now, whereas previously they thought they were going to increase. With increase in supply, buyers are gaining more options and time to decide, while sellers are cutting prices at record levels to attract bids. Now, it really seems like all of the information and data is starting to point to the fact that we're likely starting to transition in more and more markets across the United States from a seller's market to a buyer's market. Now, it's been interesting to watch. I've been talking about for the last couple of years how I think interest rates are going to stay high for longer. And what we've actually seen happen is that sellers have been very hesitant to lower their prices, even though a lot of them are not getting the activity that they want in selling their home or selling their investment property, because they were expecting rates to go down sooner. And a lot of buyers hadn't been out there looking for homes or trying to buy because they were expecting rates to go lower. But now we're kind of hitting that critical period where rates haven't gone down and they may not go down. And so sellers that actually want to get their property sold are finally lowering prices, or they're going to have to start lowering their prices if they want to clear the market, clear some of that inventory off the market. Now let's talk about what's happening with inventory levels for a second. We're now looking at Fred, which provides statistical data for the United States, and I'll go ahead and post links to all of this information that I'm covering down in the description below if you guys want to check any of it out. But importantly, we're on Fred. We're looking at new one-family homes for sale in the United States. So these are new homes, and look what's going on here. If we go back to 2006, right before we kind of had the financial crisis, all of the, bad mortgages started to unwind, the housing market crashed. We see that we were about 572,000 units of inventory available on the market. And look what happened. Obviously, the market started to recover back then. Inventory went extremely, extremely low. And then gradually over time, it has improved. But look where we're at now. We're back up to about 500,000 units on the market. And this is definitely not a good sign. If you draw a line straight across, you can see, we are way above the inventory levels that we traditionally have been historically. Maybe the average is, say, 350,000 historically. And now we're starting to approach that sort of peak inventory, during the crash around 2006, 2007. So definitely not a good sign. Additionally, if we look at months supply on Fred, months supply of new houses in the United States, we see pretty much the same thing. During the housing crisis back here, 2009, we were at 14.3 months supply. That's a lot of inventory supply for the market. And look where we are now. We hit an ultimate low during COVID. Obviously, a lot of people weren't selling. And now we have a new home supply around 8.8 months, which is well above normal supply levels for average market in the United States. So what this is really telling us is that the market is slowing down drastically. Inventory levels are really starting to build in many markets, and sellers are not able to get their homes sold. Of course, there's always homes that are selling and people are always buying, but we're just talking about the averages, the number of homes that are sitting that are not selling, the amount of inventory on the market, etc. And we see that it's just rising and rising and rising. Now, there's a lot of markets in the US where prices have already started to come down, down and inventory levels have skyrocketed. But certain markets like Los Angeles, where I'm located, are still doing pretty well overall. We have seen price increases year over year, but of course that could change as we move forward. The next thing I want to talk about is just some leading indicators that are also kind of painting the picture on what's happening in the housing market in the US. So let's take a look at a few of those. So this is pretty interesting. I wanted to share this with you guys. If we look at Redfin and Zillow to see what their stock has done, it's pretty remarkable to kind of see what's happened. Redfin's, I think, the most extreme, and Redfin attempted to really come in the market and kind of undercut the traditional real estate industry by offering lower prices. And really, it turns out that that was at the expense of the investors of capital into the company, because I don't believe they've ever had a single year where they were profitable. So essentially, they've just been destroying capital the entire time they're in business. Of course, they just got an offer from Rocket Mortgage to be bought out recently. And amazingly, that offer was nearly double what the stock price was trading at, which I think is pretty interesting. I think Rocket Mortgage has some strategic plans. Obviously, they want to use a lot of those eyeballs that are on Redfin to sell more of their mortgages. So, they've obviously done the math and worked the numbers, and they think it makes sense. Looking at both Redfin and Zillow here, you see they kind of peaked out in 2021. Actually, I think the highs were higher than this. They were probably intraday highs, and that's why they're not showing up here, because these are probably closing prices. But in any case, doesn't matter. We're looking, Zillow was up at 174.58 and Redfin was at 86.36. And today, Zillow's trading around $63 and Redfin's at about $9. And remember, Redfin popped almost double on the news of Rocket Mortgage, or the offer that Rocket Mortgage made. So they were really trading at under $5 actually for quite a while just recently. So that means Redfin has lost about 90% of its value, and Zillow has lost almost 75% of its value in a pretty short time. And obviously, these are indicators of what's happening in the housing market, the lower volume of transactions, less activity, less advertising dollars going into Zillow from realtors, etc. Next, we'll take a look at XHB. That's a home builders ETF that has a whole bunch of different names in it in the housing market in general, and certainly not as bad as the stocks of Redfin or Zillow, but kind of painting the same picture. XHB actually peaked around October 2024 at around 120. And it's been trading around 90, a little lower, a little higher just recently. So about 25% decline just across the board in a lot of these home building or real estate related stocks. Now, once prices start falling, that's kind of a big domino to fall. If buyers start to think that prices are going to start to decline, then some of them might wait longer. They might sit things out. More sellers that actually have really wanted to sell over the last couple of years that haven't, because they've been concerned about the interest rates when they buy the next property, they're probably going to rush into the market to sell because they see the writing on the wall. They're going to want to get rid of their property while prices are high. So inventory is going to build, and all of a sudden we could see a shift in the paradigm and things really slow down and prices to start plummeting. Now, I just want to talk about some of the reasons why this is happening, and let me jump back in and show you some important data points. All right, now we're looking at an article here on Zero Hedge. And again, I'll post this article down in the description below if you guys want to take a look at it. But they did a nice job of summarizing kind of some of the reasons why we're seeing this shift in the market right now. First, we have a chart that they pulled in from Fred into the article that shows the home price index. And what we see here is that we are drastically above where we were at the previous peak in housing. Now, obviously, with higher interest rates, lack of affordability, that is not going to be sustainable, unless interest rates are very low or wages are rising, which they really haven't been in the United States. So next, if we look at affordability, this really paints a pretty dire picture. Affordability right now, according to this chart, says that we are below where we were during the last housing downturn. So from an affordability standpoint, with the high rates right now, high prices, and rising costs of owning real estate, affordability is at an all-time low, making it very difficult for a lot of buyers in different markets. This next chart shows us the housing payment as a percent of median income. And what we see here again is that we're at a very, very high level. We surpassed the 2006, 2007, 2008 housing bubble. we're now at 46.9%. Now that's a very large part of somebody's income that they need to put towards a housing payment to be able to afford a house. And of course, on top of that, we're seeing rising costs for everything related to real estate across the board because of inflation. Here we can see a nice little heat map that shows us where property taxes are rising across the country. We see some real hot spots there. Obviously, as prices rise, generally property taxes rise. Now, each state does it a bit differently. But this gives you an idea of where property taxes are really rising. And lastly, we all know that homeowners insurance is also rising very quickly, especially in states like Florida and California, where there's been a lot of natural disasters recently. And this is really causing the cost of ownership to really skyrocket, along with all the other costs that everybody's facing. And then in addition, the higher interest rates on top of that. So that really gives you an idea of why Zillow is probably predicting that home prices are going to start falling. Now, I think the main factor that is causing all of this to happen is the high interest rates. Obviously, if somehow the government's able to lower interest rates, that's going to increase demand and probably heat the housing market back up. But as I shared recently in a previous video that you can find up here, I don't believe mortgage rates are going to fall anytime soon. I think it's more likely than not, higher probability than not, that we're going to end up having higher rates for much longer than everybody expects. Don't forget to like and subscribe. I hope you guys enjoyed the video, and we'll see you on the next one. Take care.